Bitcoin's capital investment, your time horizon needs to be minimal 4 years. I would actually say look at the moving 4 year, the simple moving 200-week average, the 200-week simple moving average, or the 4 year average. And I would invest like with a 4 year DCA, dollar cost averaging type approach if you're going to invest in Bitcoin. And you really want to have the intent to hold the product, hold the asset for a decade. And if you can't wait a decade with no cash flow, and if you can't stand the volatility, then I would say you ought to buy the credit. Uh, If you believe if you believe in digital assets or digital capital, you believe in Bitcoin, but you can't stand to wait for a decade and take the vol, you should buy the credit and just take the 11% tax deferred, with much, much less volatility and with someone else stomaching the pain for you.
Saylor begins by confronting a sensitive topic directly: periods in which the company engaged in actions that were dilutive on a Bitcoin per share basis. He emphasizes that these actions were neither routine nor opportunistic. They occurred during very specific moments in the company's history, primarily when legacy debt structures, such as asset-backed loans or senior debt with restrictive EBITDA covenants, posed a threat to long-term growth and balance sheet flexibility. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
We don't aim to reproduce those weeks. The times that we've actually done dilutive transactions on a Bitcoin per share basis where if you go back to the crypto winter when we had to recapitalize some toxic debt on our balance sheet, we took out debt, either it was like asset-backed loans or senior debt that had EBITDA covenants that we felt were crippling the company's growth prospects. And so we didn't do it enthusiastically, but we did it because over the 10-year time frame, we knew we needed to remove those toxic elements to our balance sheet. If you look at these 3 weeks, when we took actions that were somewhat dilutive, they all were generally associated with building up the US dollar reserve. And we did that in response to analysis and feedback from the market and some reflexive concerns that we wouldn't be able to pay the dividend if the equity capital markets closed to us. So we wanted to get ahead of that and address the credit quality. So the reason we did it, and the short answer is we do it to improve the credit worthiness of the company. And if we felt that there was a credit problem, we would do it. Right now, we feel that we've built the US dollar reserve to the level where we don't have a credit problem. We're good for the next few years. We don't have any of those other forms of debt, the senior debt or the asset-backed lending. So the balance sheet is in much better shape today. Going forward, we wouldn't electively or programmatically issue equity to buy Bitcoin if it was going to decrease Bitcoin per share, right? We don't think that's a good idea. We would only take those actions when we feel like it's essential to defend the credit of the company, because if people lose confidence in the credit, then that will ripple into losing confidence in the equity and then losing confidence in the business model in general. So it's a practical consideration, but I don't think we expect to see anything of that magnitude going forward, because the first $2.25 billion of US dollar reserve was a big move. The second topic is really what are the catalysts for Bitcoin price to improve? Look, I think the fundamental catalysts are regulatory support. We have the most constructive set of financial regulators in the history of the industry right now. The head of the Fed, the head of the Treasury, the head of the CFTC, the head of the SEC, and the White House has a digital assets czar, right? Those 5 things are massive bull flags. They're all very positive, and generally you would expect that something good will come probably out of the CFTC or the SEC as they are constructive about facilitating financial companies to innovate in the digital asset space, right? I would have been skeptical about that 2 years ago, but I think for you to be skeptical about their support for digital innovation today would be ignoring all the words from everybody in those positions. And I think that the second catalyst will be banking adoption, the formation of the banking credit networks. As the large banks and as companies like Schwab, they start to allow you to trade Bitcoin, custody Bitcoin, borrow against Bitcoin. They're going to legitimize the asset, and they're going to decrease the volatility of the asset. They're going to improve the usefulness of the asset. You're aware of the announcement of the BlackRock Bitcoin Volatility Income Fund that came like about a week ago, where they said they were going to sell volatility or generate income. And a lot of people that speculate that will decrease the volatility of Bitcoin and put a more stable floor into the asset. So I think the actions by big finance, the actions by the big banks, and the actions by the financial regulators are the fundamentals. I mean, those are the fundamental things. And if you were to light a candle and pray, to the gods of the crypto sphere, you would say, I want pro-digital assets regulators, I want pro-digital assets banks, and I want pro-digital assets financial innovations like BlackRock's bringing to the market, like we're bringing to the market, right? Like STRC. But fundamentally, the industry is going to move forward because of enlightened regulation, engaged, thoughtful banking, and then innovative finance. And that's what we're doing, and that's what we see right now.
If Bitcoin grows at 30% annually, Saylor argues, then a $45 to $50 billion company can simply sit still and compound naturally. Even at 10 or 20% growth, the default strategy of inaction remains acceptable. Capital markets activity is reserved only for moments when it is clearly accretive to shareholders. When the company does act, it does so incrementally. Rates are adjusted slowly, typically no more than 25 basis points per month. The goal is stability, not shock. Instruments like STRC are managed carefully to trade near par, reinforcing confidence and minimizing volatility.
We try to be very reactive to market signals. So for example, when our equity trades weak, we don't sell it. When our credit instruments are trading weak, when the cost of credit is too high, we don't sell them. The most obvious is STRC. If it trades below 100, we don't sell it. So in periods where the marketplace loses confidence in our particular credit instruments, we simply wait. And in periods when the MNAV of the equity explodes to 3 or 3.5, we might sell $1 billion a day, right? So when the capital markets are enthusiastic about either the equity or the credit, we react to them. And it's above our pay grade to set financial policy. It's even above our pay grade to interpret like the financial policy. Like sometimes the macroeconomy has one set of numbers and you would think it's good for Bitcoin, but it's bad for Bitcoin. Or another time you would say, well, if they do this, that should be good for us, and it's not good for us. And then other times it's the opposite. I think the nice thing about our business is we have the option to do nothing. And we have a set of disciplined capital markets programs. They've moved from being discrete, where it's like, well, we got to do a deal this quarter. What's the deal we're going to do in Q3? And we've moved from discrete 144A capital markets programs to continuous ATM type programs. And with the ATMs, if the market thinks, that the cost of capital on an instrument like STRF should be 11%. Well, we just don't want to sell it. So we think it ought to go to 8%. So when the market takes STRF to 140 or whatever the price it is that we think is fair, then we will be open to issuing more. And when the market is bearish on those instruments, we don't. And the good thing about the business is if you think Bitcoin is going to grow, fill in a number, 30% a year, then our option is just do nothing. And we're a company that's a $45-50 billion company growing 30% a year. So that's our default. Our default, if you think Bitcoin's only going to grow 10 or 20% a year, our default is we just do nothing and we grow at the rate of Bitcoin, and we're okay with that. And then if we think that there's something very accretive that's going to be good for the shareholders, then we will participate. And we can participate, in size $1 million a day, $100 million a day, $1 billion a day. We can't lower the rate more than 25 basis points a month. So we're always going to be very incremental, and we would only lower the rate when in such a way that we thought it would stay in that zone of 99 to 101. Like we want to keep it targeted at 100. So, you might 5 years from now find out that the rational credit spreads that the market assigns us are 300 basis points instead of 600, and that people would like to buy this thing at 400 basis points over SOFR, maybe. But we would very gradually get there, and we would still expect STRC to be trading around 100. And so we're not looking to do anything that is jarring to the price. We want the price to be stable. As a practical matter, the reason that we would lower the dividend rate would be we had such an avalanche of demand. We had too much demand, and people want to buy infinite, and we don't want to sell infinite because we'll drive the BTC rating of STRC down, right? Like if hypothetically someone said, I want to buy $100 billion of STRC tomorrow, you can see how we don't want to sell it because, right? Because then that's reflexive, and that would undermine the credit quality, and that would increase the volatility, and that, that kind of works against everything. So luckily for us, and practically that's not going to happen, right? They say, it's good that we have time because otherwise everything would take place at the same time, right? all at once. We don't want stuff to happen all at once. So it will happen progressively. We'll be very thoughtful about it. Our goal is always for it to be extremely compelling to attract capital. And at the point where we feel like we've got too much capital, it would be a circumstance, Larry, where there was massive success of STRC and Bitcoin was lagging, and MSTR equity premium was lagging, and there's that weird situation where it's hard for the company to increase its collateral base in order to back the credit, and then we would say we have too much demand for the credit, so we need to click it down. But if there's over demand for the credit, it would still be pegged at 100 when we take it down 25 basis points, and so we're going to responsibly manage this so as to minimize volatility, maximize stability, and in all likelihood, it's going to be excessively compelling in terms of dividend rate for quite a while, because even though you believe in Bitcoin as collateral and I believe in Bitcoin as collateral, we've got a lot of work to do with credit rating agencies and the Basel rules and traditional finance establishment before they recognize it as being good collateral. And as long as they don't, then that means probably the spreads are going to stay pretty compelling. I think we've got an unprecedented number of invitations to financial conferences and meetings with investors in general. And I think that the amount of interest in this topic explodes. And when the volatility explodes, the engagement explodes. What I would tell them is the same. We've kind of said for a while, Bitcoin's capital investment, your time horizon needs to be minimal 4 years. I would actually say, look at the moving 4 year, the simple moving 200-week average, the 200-week simple moving average, or the 4-year average, and I would invest like with a 4-year DCA, dollar cost averaging type approach if you're going to invest in Bitcoin. And you really want to have the intent to hold the asset for a decade. And if you can't if you can't wait a decade with no cash flow, and if you can't stand the volatility, then I would say you ought to buy the credit. If you believe in digital assets or digital capital, you believe in Bitcoin, but you can't stand to wait for a decade and take the vol, you should buy the credit and just take the 11% tax deferred, with much, much less volatility and with someone else stomaching the pain for you. And so I think it's kind of simple, right? You either don't believe in Bitcoin at all, and then you don't want the credit or the capital, or you believe in Bitcoin as a maxi and you want the equity because you want 2x Bitcoin, or you want Bitcoin as as sovereign, censorship resistant, long-term store of value to give to your great grandkids, who may be living in a country you don't even live in right now, and you want to self-custody, then you buy the Bitcoin. Or you just think all this stuff looks really good, but you need the money back in September, then you think about the credit, right? And specifically the treasury credit, because the other credit instruments are too complicated. So I would say we're really at this point pitching the treasury credit, as the first step in a Bitcoin journey for a traditional or conventional investor who believes in digital assets.
Saylor concludes with a clear framework for investors. Bitcoin itself is a long-duration capital investment, best approached with a 4-year or longer horizon and a disciplined dollar-cost averaging strategy. Those who cannot tolerate volatility or decade-long holding periods may be better suited to Bitcoin-backed credit instruments, which offer yield with far less price fluctuation.